Hello, everyone. Welcome to Andersen Estate Planning Tax 101. My name is Atif. I have been with Andersen for 2.5 years. Before that, I worked in Big Four and medium-sized firms. And I am based in Calgary, and I'm joined by Zach. Zach, why don't you briefly introduce yourself?
Thanks, Atif. My name is Zach Bronstein. I joined Andersen just last month. I've been practicing for over 14 years in an income tax advisory specialization with a focus on domestic Canadian owner-managed tax planning.
Thank you, Zach. So some housekeeping matters. There will be opportunity for audience participation today. There will be 3 polling questions. There will be a survey, and there will be a live transcript that will be offered to you, and you will have the opportunity to ask us questions at the end of the presentation. So they say there are 2 certainties in life: death and taxes. Death, we cannot minimize, but tax, we can minimize. And hence our presentation today, estate planning. The agenda of our presentation is we will talk about objectives of estate planning, and we will briefly talk about how does it look when you don't do estate planning, what kind of adverse tax consequences can result in. We will talk about estate freeze, which is one way to manage your estate planning. And we will talk about probate planning and use of trusts. Trusts are wonderful tools in the hands of tax planners and legal planners. And we will talk about some ongoing considerations once you have set up your estate plan, what to keep looking out for. This presentation is not about US tax. We have done presentations on US tax and US estate planning involving US tax before, and we will be doing them more. Today, we will just talk about some of the issues that you have to watch out for. So what is the objective of estate planning? So Zach shared this cartoon with me, and I thought this should go to into the presentation. So here's a lawyer reading out the last will, and there are kids sitting on the other side of the desk, and one of them is expecting nothing, the other is expecting too much, and the third one is just not showing her cards. At the end of the day, estate planning is about managing the expectations of your family members. There is always a dispute as to what is expected and what is fair. And this cartoon kind of conveys that point very well. Thanks, Zach, for sharing this one. So the objectives of estate planning is family and shareholder dynamics. So as we said, there's a family dynamic to every situation. And when you are distributing your wealth that you have built or increased over your lifetime, there's going to be some concerns, some expectations, different definitions of subjectiveness. And that's where estate planning can come into play. And when properly done, it can manage those expectations. It can reduce the conflict proactively. It can also manage the situation where there is a business in the family. So you can manage what the shareholders look like, who will be the shareholder, who will be running the business, who shouldn't be running the business. And you have to think about succession planning as part of a estate plan so that your family, the right person takes over the business, but it does not mean that the other family members do not benefit from the growth of that business. Anyways, at the end of the day, it all depends on the family dynamic. And then there's a minimizing tax at death that estate planning allows. Zach, can you discuss some scenario with us where this can come handy, estate planning, different family scenarios?
Yeah, absolutely. So all the first scenario I'll offer is is mom and dad want to do some estate planning, and they have what you might call sort of the traditional nuclear family. So they've been high school sweethearts and married for 40 years. They have a number of children together, and the family dynamics are smooth. Everyone gets along swimmingly. There's no conflict around the Thanksgiving table. And so that's the first scenario I'll paint for you. And then the second scenario is one in which you have, say, a blended family. So you have two spouses who um, have had previous relationships and previous marriages and children in those other relationships and other marriages, as well as some children together. And so all else equal between those two scenarios, I'll turn it to you, Atif. Between those two scenarios, which scenario do you think would invite some additional planning and some additional considerations to deal with the circumstances?
I'm sure it's not the nuclear family. Most likely, blended family will have more dynamic, more situations. So estate
Exactly.
planning might be handy for them.
Absolutely right. So families, but the blended family with children from different marriages and relationships will invite more considerations and more planning to respond to the increased complexity in the family dynamic and the relationships. Um, another small example I'll offer is um, say again, you've got mom and dad doing some estate planning for their children, and their children are married. So their children are adults, they're married, and mom and dad get along with the in-laws swimmingly, beautifully. Mom calls her son's wife, so her daughter-in-law, she calls her the blood daughter that she's never had. And so contrast that scenario with another scenario where mom and dad have adult children and they love their adult children. Those adult children have their own children, so mom and dad have grandchildren. And so they want to provide for their adult children, they want to provide for their grandchildren, but they're apprehensive of their children's spouses. So they're apprehensive of their son-in-law or their daughter-in-law, as the case may be. And so between, again, contrasting those two scenarios, all else equal, which of those two scenarios do you think would involve further considerations, further planning, further restructuring potentially?
I think I got this one. So there, where there is more chance of conflict, where there is more uncertainty as to how the relationships dynamics work, the more the chance and more the need for the estate planning. So in this case, if you're not getting along with your in-laws, then that's where estate planning would come handy.
That's absolutely right. And so some of the planning might involve the transfer of assets to these children or to these grandchildren in such a way that, say, protects those assets from future Family Law Act claims under a future separation or divorce if the parents are paranoid or skeptical that a divorce or separation might be forthcoming. And so, once again, I think between these different scenarios, it shows that while no two families are identical, the more complexity and nuance exists between the family dynamics and the family history and the relationships, the more considerations and planning and structuring needs to go into crafting the best estate plan for the circumstances.
Right. And at the same time, when you are crafting these plans, you want to make sure that you are minimizing tax at death as well. So there's a balancing act that you can play to make that happen. And so let's talk about briefly about double taxation. You might have heard that phrase. What does it exactly mean? And how does that come into play? Well, if you have no estate plan in place, let me give you one example. So a taxpayer owns shares of a company and the fair market value of the shares is $10 million. Now, ACB, let's say, is nominal. He started out a business. He did not contribute much into the business, and the business has grown pretty significantly. So at the time of death, the tax rules work in a way that they will say that the shares are have been deemed disposed of. What that means is that there's going to be a taxable capital gain of $6 million after capital gain exemption, resulting in the tax of $2.9 million. Now, if this corporation is OpCo, then maybe you don't need to do anything else and keep working at it. But if it's an investment company, then you have to redeem the shares. And the way the rules work is that redemption of shares triggers another $4.2 million of tax. Now, if you take that 2.9 million deemed disposition of shares at debt and then add it to the 4.2 million upon the redemption of shares, we have a total tax of $7.1 million. That's a 71% tax. And that is, you worked hard to make that business turn into a $10 million value. And now 7.1 million will be gone to the tax tax CRA. So you are left with only 2.9 million. Doesn't sound very tempting to be a victim of double taxation. But luckily, there are some plans that you can put in place around this situation, and I'll let Zach touch upon those.
Yeah, thanks, Atif. And yeah, that 7.1 million is staggering. And so certainly um, uh, taxpayers and their planners would be justified and well within their rights to implement tax planning that's fully compliant with tax laws, but that still reduces the taxes down to a more um, reasonable amount. And so one of those forms of tax planning that an estate can do is what's referred to as a subsection 164.6 loss carryback. And so, as Atif explained, when those shares get redeemed, you have a taxable dividend, which is giving rise to that $4.2 million tax bill that Atif listed. It also gives rise to a capital loss because those shares have cost base and then they're being redeemed. And so there's a capital loss now in the estate. So under Canadian tax rules, a capital loss can only be utilized against a capital gain. And so if the estate has no capital gain, which absent the additional planning, it doesn't, that capital loss is stranded. It can't be used, which is what's contributing to the double tax scenario that Atif just described. And so the 164.6 loss carryback is a tax planning point and election that allows for the estate to carry back that loss against the capital gain on the final personal tax return, which is known as the terminal T1 return. And so that capital loss no longer becomes stranded in the estate. Instead, it can be utilized against the capital gain on death due to the deemed disposition. So at least one of those tiers of tax now gets eliminated. A technical point is that that capital loss can only be carried back to the terminal return, the final personal tax return, and not previous years. Another consideration or point to getting the overall taxes down would be to give consideration to existing tax attributes within the corporation itself. One of those tax attributes is the RDTOH, which is an acronym for Refundable Dividend Tax on Hand. And so that is a pool that a Canadian corporation maintains that represents the balance of refund that the company will receive based on taxable dividends that it pays. And so for every dollar of taxable dividend it pays, it receives a dividend refund of 38 cents on the dollar, up to the balance of the RDTOH pool. So if a corporation has an RDTOH pool, planning that makes use of that pool to maximize the dividend refund in the circumstances can also further help to bring the overall tax liability down. Another favorable tax attribute is the capital dividend account, so CDA in short. And that is another favorable tax attribute that is once again maintained in the corporation itself. And that represents a pool out of which the corporation can pay tax-free dividends. And so once again, that's favorable because whereas ineligible dividends attract a very high rate of tax, capital dividends can be received tax-free. And so if there's CDA within the company, developing an estate plan that makes optimal use of that CDA balance will also help to bring the overall tax liability down. I will also mention that these are just two planning agendas or points, and it is not a comprehensive list of estate planning tools that are available, but it offers an introduction to some of the estate planning tools that are available in the circumstances.
Right. And Zach, they're not all these different plans that are on the screen and are not on the screen. They are not necessarily exclusive to each other. We can use them, make them work together to come up with a better tax rate.
Exactly. So practitioners will sometimes call that a hybrid plan or a hybrid estate plan that makes use of not just one tool, but multiple tools to get an even better tax rate than had you just used one tool alone.
Exactly. Okay, just one little on a light note. There's a cartoon that we came across. Uh, I will let everyone take 5 seconds to read it. So the point that this cartoon is making is that every situation is different. Your needs are different. Your family dynamics might be not complicated. You might just have one kid, or it could be very complicated. So you have to come up with a plan or work with a professional to come up with a plan that suits your needs. You don't want to create complicated estate plans or series of trusts to handle situations. Don't do it too much where your legal fees become too complicated, too high, and then you end up in a situation where you have to monitor these plans. So finding the right balance, this cartoon kind of conveys that on a lighter note. So here's a quiz time, and I invite everyone to answer this question. So why do estate planning, tax minimization, avoid probate, business succession, all of the above? Everyone has answered. We will display the responses on the screen. Okay, 96% said all of the above, and all of the above is right. So tax minimization, we talked about, business succession, we talked about, and we will briefly talk about probate in the presentation as well. So good job, everyone. Now, so if there is no estate plan, there are other plannings we can do to fix the tax consequences. So if you have assets like RRSP, RRIF, and there are no direct beneficiaries, they become subject to probate fees and delays, and there are other assets, investments, and properties that you have to be careful about. So Zach, why don't you talk about how the Ontario rules work, and I'll briefly touch upon the Alberta and BC.
Certainly. So in Ontario, um, when a um, when a will gets probated, and so that's based on the estate itself and the composition of assets that are in the estate. If there's found to be a need to have the will probated, then an application needs to go to the courts for a certificate of appointment in which the executor or executors are certified by the courts to be the representatives of a lawful and valid estate. And so that's a court filing that empowers the executors to fulfill their capacity and requirements and obligations and duties as executors. But that carries a fee with it, and the fee is proportionate to the estate value itself. So if the estate value is small, and Ontario considers a small estate less than $50,000, then there's no probate fees. But if the estate being probated has an estate value that's in excess of $50,000, the probate fee is 1.5% on the estate's value. And so to offer an example of what that might look like, if someone passes with a $3 million estate and their estate needs to be probated for the reasons I mentioned, then in Ontario, that would attract a $44,000 probate fee.
Right. And in Alberta, the probate fees are not significant, but they are significant in BC. They are nominal when the fair market value is $50,000. For amounts over 50,000, the fee is 1.4%. So the numbers can add up quickly, but these are the monetary costs of probate. There are other costs as well. For example, Zach, maybe you can add what I'm going to say here, but if you're a business owner and you pass away and the shares of the corporation becomes part of the probate, and there could be lengthy delays of months or spread out over months, or how the probate evaluates the properties for inheritance and all that stuff. And then for those times, there is a limited scope available for the business owner to be making some business decisions. They might be restricted in that scenario. So probate is not just monetary cost, it can have impact on access to funds, running the business as well.
Yeah, and I'll offer another example as well, Atif, because um, I had a client whose estate did need to get probated because they had already passed away. They hadn't undertaken estate planning, and their adult children had come to me for some estate planning advice. And so the estate comprised um, real estate property, which is what required that the estate be probated um, so that the estate would be able to transact on the real property and sell the real property. But there were also shares in the estate as well. And so, for the reasons we mentioned, remember that the probate fee is proportionate to the value of the estate. And so, arriving at a reasonable, quantifiable value of the estate assets becomes important. And so, when private company shares inform part of that estate value, um, typically a valuation is required in order to value those shares so that the overall value of the estate can be determined and so that the appropriate probate fee can be remitted. And so by having this bundle of assets, which included these private company shares, the valuation needed to be performed and completed, which can also be a time-consuming process in order for the application to the court to move forward. And so the accessibility of a readily determinable value also becomes important in order to quickly identify the value of the estate for purposes of the probate.
Right, Zach, you make an excellent point there. And valuation can be a time-consuming as well as expensive process as well for the taxpayer.
Exactly.
Okay, so there are different ways to do probate planning. There is alter ego trust, spousal trust, direct designated beneficiaries, dual will strategy. So alter ego trust, Zach, do you want to unpack for us what does alter ego trust mean and how does that fit into the probate planning?
Yeah, so an alter ego trust is a form of trust that allows for assets to be transferred by the individual into a trust on a completely income tax deferred basis. And so there's certain rules that need to be met in order for that transfer to be tax deferred. But one of those would be that the transferor be at least 65 years old. So if they're 65 years old and they set up a valid alter ego trust, they can then transfer their properties to that trust for their benefit. And by doing so, the assets that otherwise would have been in the estate are actually now property of the alter ego trust. And so that reduces the value of the estate that forms part of the probate application which reduces the overall probate fee. So an alter ego trust would be one such planning tool to reduce the overall probate fee.
Is the alter ego trust exclusively for probate planning, or there could be other applications as well for this trust?
Um, Creditor proofing in the circumstances could be another useful tool for the alter ego trust.
Right. And spousal trust is where you move assets to a trust for the benefit of your spouse, and the rollover is available for this one as well. And direct designated beneficiaries. Zach, you want to take that one?
Yeah, so you had listed, I believe it was the TFSA, RSPs, RIF accounts. I would also add life insurance policies as well to that. Absent any direct designated beneficiaries, typically those funds, those accounts form part of the estate value. So if there's a significant life insurance payout, but no direct designated beneficiary on that policy, that goes into the overall value of the estate. And so now when that estate gets probated, the estate value, which attracts the probate fee, also includes that life insurance. So by just kind of going through that simple process of listing direct designated beneficiaries where possible, those assets can be transferred immediately outside of the estate, outside of the probate application, and thus reduce the probate fees.
Right. So if you're in a bank and a person asks you, the banker, that who should be the beneficiary, just by mentioning the beneficiary at that time, you save a lot of headache later on. So dual will strategy became a thing in Ontario. Zach, since you are based in Ontario, why don't you talk about it?
Absolutely. So I'll bring to mind the example I gave just a few moments ago, where um, a client situation was brought to me by their adult children because mom and dad had left an estate which included both real estate property as well as private company shares. And so I had mentioned how valuing those private company shares was necessary for purposes of the probate application, and how the real estate property and the shares were bundled together in the estate itself. A dual will strategy is a strategy that separates the bundle of assets that would otherwise require probate from the bundle of assets that otherwise wouldn't require probate. And so, had a dual will strategy been implemented, that could have included a situation where the real estate property was addressed under the primary will and the private company shares were addressed under a secondary will, so that the primary will, when it gets probated, would only include the real estate property and not include the private company shares. And so that saves the headache of the valuation and it reduces the probate fees because the private company shares are no longer under the probated estate. Rather, the private company shares are addressed by a secondary will, and the secondary will dictates how those private company shares are to be transferred to the inheritors under that will. And so that's why it's called a dual will strategy, because you have a primary will as well as a secondary will. And by splitting the two, you can designate one for probate and leave the other to not have to undergo the probate process.
Right. It seems like a very straightforward, simple strategy to save a lot of headaches when it comes to, as you said, running your business. You don't need to do the valuation process. You don't need to your business will not be disrupted, its operations, just because you placed your shares of the operating company in a different will.
Yes, and I'd like to add another insight to that, Atif, because you're right. It is a very simple strategy that can be powerful. It's important, though, that when implementing that strategy, that that you seek proper legal and accounting and tax advice, because you want the dual will strategy to fit with the overall comprehensive estate plan. An example I've seen in my experience where that hasn't been the case is where mom and dad kind of went to a DIY wills shop and had a primary and secondary will for a similar situation, primary will for the real estate, secondary will for the private company shares. But the secondary will was so it was so limiting that it didn't empower the executors of that will to undertake reorganization type activity, which could be important and necessary when implementing, say, the 164.6 planning that we've talked about, as well as other post-mortem estate planning. So you still want the dual wills to still empower the executors of those wills with the appropriate ability and privileges and rights and powers to undertake further estate planning as might be called for with those particular assets.
No, you make an excellent point there. All your different pieces of strategies just come together and work in unison to make things work properly. No, that's a great point. Okay, so use of trusts. Trust is a powerful tool. It has tons of commercial and personal applications. It's very flexible, as we briefly touched upon alter ego trust, where an individual is a settlor and he's also the beneficiary. And there is a spousal trust where you can leave assets for the benefit of your spouse. There are a joint partner trust where both spouses are the beneficiaries as well. And they are designed to achieve different objectives. One example is that if there is a family cottage and you leave the family cottage in a trust for the benefit of a child, but in the trust agreement, you talk about how other family members would be allowed to use the cottage and how if the beneficiary wants to sell the cottage, first he has to talk to the family members who might be interested to buy. So a lot of situations where trust can be used powerfully. It can be used for charitable donations, charitable giving. It can be used for estate freeze, which we will talk about a little later. It can be used in multiplying the capital gain exemption. And some of the uses were mentioned by Zach in some of his examples of how the family there might be a blended family and children from two different marriages, how you can use trust to create fairness and avoid or minimize conflict after you have passed away. And trust can be used for ownership transition. Tons of use for trusts. One of the things to watch out for is that the trustees will be in control of the trust. Uh, and you will have to appoint a trustee, keeping in mind that you trust that person has the capability to administer the estate or the trust, and that person is trustworthy, as it says in the word trustee itself. You can have more than one trustee. You can have three, and you can choose that it could be a unanimous decision of all three, which can be a little bit problematic. Generally, people go with majority decision of trustees. So if there are three trustees, two of them can vote in favor of a decision, and that decision will prevail. One of the things to watch out for trustee is that they don't make sure they're residents of Canada. And sometimes it is included in the document that as soon as trustee leaves the country, becomes non-resident, then that trustee is considered to have resigned from his post, and you will have to come up with a new trustee, and you have to watch out for some of the rules. But the point is that if the trustee become non-resident, that can create a whole foreign tax implications that can result in more cost for you and more problems and headaches. Zach, you want to discuss any more points here?
Yeah, so just an overall qualitative point that any trust structure that's introduced, you want it to be commensurate with the circumstances, the complexity, the family dynamic, because you don't want to land into the cartoon that you shared, Atif, where, at the end, the child's looking at the overall estate and the inheritance they're getting, and it's being absorbed and consumed by legal and advisory fees and the like. So certainly trusts have their place, and they're an important tool in the toolbox. You just want to make sure that it's being used in the circumstances that it's truly required to get the most value for the fees and costs and compliance that's attached to a trust.
Good point. Hey, when you're using trusts, you have to be careful though about certain things. Watch out for unexpected association. What do I mean by that? What I mean is that the corporations, if they qualify, they can use small business deduction and pay tax at a much smaller, lower rate than a regular corporate tax. And the companies that are associated have to share the small business deduction. So if you have two corporations, because you are the owner of the both corporations, they are associated, and you have to use this, share the small business deduction. Now, when you set up a trust, there are rules that say that now the beneficiary is assumed to own the shares of the corporation if the trust owns the corporation. And suddenly, that what that does is that it can trigger association rules, and now you will have to share the business that is owned by a corporation, by a trust, and the business that is owned by a beneficiary separately. They can become associated, and then you have to share the small business deduction, and you can lose significant tax savings. So watch out for unexpected association. When you're setting up beneficiaries, setting up a trust, and you have a business in place, watch out if there is any tax consequences there. One of the use of trust is to split income. However, you have to be careful about the TOSI, tax on split income. There are some rules that you have to watch out for. There's attribution rules, and how that works is that if you have set up a trust, settled a trust, and you have contributed a property that is earning income, then and if the beneficiary is a minor child, nephew, or niece, or your own children, the attribution rules can kick in, and you will be attributed that income from the property. So if you are on the higher marginal rate than your kids, that's not the result you want. Watch out for 21-year deemed disposition rules. That is something that is often missed. Make 21 years go by pretty fast. Time goes by pretty fast. And before you know it, you will be calling your tax advisor and say that, hey, my 21-year deemed disposition rules are kicking in, and I have 10 days to figure out a solution. Try to leave at least 2 years for the planner to deal with this. After 19 years, just bring it on the radar of your tax advisor that 21-year deemed disposition rules are kicking in. And what those rules do is that all the assets inside the trust are considered to be deemed disposed of at fair market value. That can trigger a significant tax consequences. However, there are, if you have time, if you've thought through things proactively, there are ways to handle this. You can do a rollover to the beneficiary tax-free if certain conditions are met. And there are other rules that you can rely on. If the property or assets have been vested indefeasibly to the beneficiaries, then maybe you can avoid the 21-year deemed disposition rules. Zach, I know you love to talk about this, so do you want to add something there?
Well, I have insights to share. I want to be mindful of time, but I will say uh, on the point of unexpected association, you raise a great point, Atif. The implications can be significant as it relates to, say, sharing of the small business deduction, among other tax rules. And so the application of that is that it's important for individuals to know when they're beneficiaries of a trust, because you wouldn't want a situation where their corporation was unknowingly associated with another corporation, and then you're dealing with that retroactively. There may be penalties and interest for non-compliance, things of that nature. So it's sometimes setting up a trust can necessitate important family conversations so that individuals know when they're named as beneficiaries under the trust.
No, you make an excellent point. If, for example, if the kid is a minor and you have made him a beneficiary, and after becomes graduates from the university, starts his own business, he might not even know that he is captured under these rules because he doesn't know he's a beneficiary, maybe. Quiz two, what to watch out for when setting up the trust? QSBC status, tax on split income, attribution and association, B and C, all of the above. So we'll give you guys a little bit of time to come up with the answer and see how well you guys are doing. Okay, B and C are 34%, and all of the above are 62%. And the right answer is a D, tax on split income, attribution, and association. QSBC status, it's a slightly tricky question. I get it. QSBC status is something you have to watch out. Actually, sorry, QSBC status is something you are watching out for as well for the lifetime capital gain exemption. So I stand corrected. The answer is all of the above. Okay, freezing value of OPCO shares. Again, this is a wonderful strategy that you can use to minimize tax at the time of death. We've already covered it conceptually, I think, but as an example, so if Mr. A owns shares of ACO and the fair market value of the common share is $5 million, and if Mr. ACO freezes the value of the shares, what he does is he exchanges his common shares with pref shares with a redemption value of $5 million. And the trust subscribes for the common shares of ACO with nominal value. And the kids or the family members of Mr. A are the beneficiaries of the trust. So what is the benefit of this freeze? So what this does is that if Mr. A dies when the fair market value of common shares is $10 million, that $10 million is captured in your tax liability or taxable income. But if you have frozen the shares and now Mr. A passes away, only $5 million is captured. And the rest of the 5 million that has grown over the years will be attributed to these common shares and beneficiaries, which is owned by the trust, and they will not be considered deemed disposed of at the time of the death of Mr. A. So by taking the simple freezing the value of the OPCO shares, Mr. A has significantly reduced his tax liability at the time of the death. Now, watch out that you want to freeze the value to the point that gives you necessary funds to live out your life. Assuming you have no other assets, no other investments, and you're depending on these pref shares, you want to make sure that $5 million before tax is enough for you for your personal expenses. So the benefits of estate freeze is allow future growth to successors and multiplying capital gain exemption and income splitting. We have already discussed some of these already. So at the end of the day, what you have is that in this example that we talked about, the pref shares are held by Mr. A, so he's still maintaining the control of the corporation, and he's doing a transition of business ownership. He's bringing his kids possibly into the business while running the corporation himself. And at the death time, the tax is minimized, so there's a better cash flow planning through this estate freeze. So last quiz, why do estate freeze? Freeze the value of shares, multiply lifetime capital gain exemption, avoid association rules, A and B, all of the above. And we will display the results once everyone has entered their answer. Okay, so freeze the value of shares is one of the reason. Multiplied capital gain exemption is another reason. Association rules are not impacted by a state freeze, so the right answer would be A and B. Okay. So once you have done the estate freeze, you have to monitor it that maintain the plan well. And I would let Zach take us on this journey as to how that can be done in the best possible way.
Yeah, so in your example, Atif, where Mr. A exchanged his 5 million in common shares at the time of the freeze transaction for 5 million preferred shares, and the trust subscribed for new common shares, you had also made the point that you would want the freeze to give consideration to his future lifestyle expenses to make sure that he has adequate cash flow in the future. And so one way in which that cash flow can be made available to Mr. A in the days and the years that follow that freeze is through redeeming his preferred shares over time. And so this puts cash into his hands. It also gives rise to a taxable dividend to Mr. A, so it's subject to his marginal rates at the time. And it also achieves the outcome of reducing the value of the preferred shares that will be in existence at his death. So by redeeming those preferred shares over the remainder of lifetime, the overall tax at death can also be reduced and minimized. Um, a similar comment is applicable here as it was earlier in the presentation, that you always want to give consideration to favorable tax attributes that exist in the company and the structure. And so RDTOH and CDA are just two of those types of tax attributes that can be favorable and should be considered in a estate freeze as well as under the wasting freeze scenario to achieve an optimized tax outcome. And
Go ahead, Zach.
finally, managing QSBC status. So QSBC status, that's important for purposes of claiming a lifetime capital gain exemption, which again can reduce the estate tax if on the terminal return the remaining preferred shares qualify as a QSBC. Then Mr. A could use the remainder of his lifetime capital gain exemption. And so a wasting freeze that removes excess cash out of the structure can help for purposes of maintaining QSBC status for the reason that inactive assets are being moved out of the company and into Mr. A's hands, whereas the QSBC rules do require a certain threshold of active assets to be in the business.
Right, and QSBC stands for Qualified Small Business Corporation. So if you qualify, then you qualify for a lifetime capital gain exemption at the time of the sale of the shares. Now, one of the practical things I would want to say is that the rules are high level. To qualify for QSBC status, the shareholder has to own the shares for 2 years. For the last 2 years, 50% of the assets should have been used for active business purposes. And at the point of sale, 90% of the assets should be used for active business purposes. Now, if you get a really good offer tomorrow for your business, but for the last 2 years, the financial information suggests that only 40% of your assets were being used for active business purposes, then you might lose using your capital gain exemption. So that's why it's so important to manage QSBC status, maintain it, that if the time comes for you to sell your business, you're right there ready to sell it. Now, this presentation I want to emphasize is not about the US taxation. I am not a US tax person, neither is Zach, but we just want to touch upon some of the US tax concerns. So if there's a US citizen that is resident in Canada and who does the estate planning, and then there is a beneficiary of a trust. Let's say you set up a trust, and then that beneficiary moves to the U.S. for his or her education and becomes a U.S. resident. And if you have ownership of assets in the U.S., then you can be captured by the U.S. estate tax. Now that can become pretty cumbersome things to watch out for. Again, there are ways to proactively plan for it. As I said before, we have done presentations earlier on this topic, and we'll be doing those presentations later as well. Now, on that note, please complete the survey. How can we improve? Topics you would like us to cover, please mention those, and we will stay for the questions.
Thank you, Atif and Zach. We do have a few questions on our Q&A, and because we only have 10 minutes left, so I only ask a couple of questions. For the rest of question, we haven't answered in our webinar. Please contact us after the webinar to discuss more detail. Atif and Zach, the first question is, I have heard about the reversionary trust rule that can cause negative tax consequence. Can you please explain more detail about this trust?
So yes, Zach, I'll take this one and feel free to add afterwards. So the reversionary trust rules deal high level. How they work is like this. So if a person has settled a trust and put asset or property inside the trust for the benefit of a beneficiary, but somehow he has maintained control over the asset, meaning that could mean that he is the asset cannot be sold without his or her without the settler's permission, and then it can what happens is it can revert back to the contributor, the settler. Now the consequences of this is that the income or that is earned by the trust can be attributed back to the settler. And there are also consequences other consequences that can kick in after 21-year deemed disposition rules kick in. If it's a reversionary trust, you cannot rely on some of the rollover provisions that you might have available at your disposal. So that's the high level how the reversionary tax rules, trust rules work. Zach, you want to add to that?
No, just to emphasize what you said, that if you knowingly or unknowingly set up a reversionary trust and you have assets that have appreciated it in that trust for 20 years, come that 21-year anniversary, there is going to be a taxable event in the trust, and it could be significant. And the ability to roll those assets out on a tax deferred basis to the beneficiaries does not exist under a reversionary trust. So very important to make sure the trust is properly structured so that you don't unintentionally create a reversionary trust.
Right. Always keep an eye on those 21-year deemed disposition rules.
Okay, thank you. The second question, we mentioned about the Canadian residents owning the real property in the US. Can you please discuss more detail about the Canadian and the US tax issue related to respect to a Canadian resident, taxpayer owning the US property? Yeah.
Zach,
Yeah.
you want to take that one?
I'd be happy to take this, and likewise, Atif, if there's anything else you would like to add, don't hesitate. So for Canadians who own U.S. Real properties, that is what the U.S. tax rules consider situs assets. Situs assets can include other types of properties. For one, real property situated in the U.S., but also stocks and bonds in U.S. companies can be another. And so a Canadian who holds those type of properties can actually find themselves exposed to the U.S. estate tax rules, even though they're not U.S. citizen. Now, there are a few thresholds for purposes of those rules. If the total value of all those situs assets is less than $60,000, then there's no estate tax liability and there's no estate tax filing. But if the assets do comprise more than $60,000 in value in those U.S. situs assets, there may be a tax filing, and depending on the overall value of your estate, there may also be U.S. Estate tax payable as well. So a detailed review of those rules is outside the scope of today's presentation. But if you are a Canadian citizen and resident and hold over $60,000 of U.S. situs assets, including U.S. real property, you are certainly encouraged to contact your tax advisor at Andersen and explore options to plan around falling into the U.S. estate tax rules.
Right. No, Zach, I think you've covered most of it, but most importantly, we are not U.S. tax specialists, so this is not a U.S. tax advice, just a general guidance. And one of the things to watch out for is that if you have an RSP account and you hold the shares of Apple in your RSP account, that could be captured by the situs, U.S. situs property rules as well. That is my understanding.
Thank you both. The next question is, I think this is this question is like we usually need to, if I have a property want to transfer to my family member, should I transfer this property directly to my kids or just move them to an estate trust?
Yeah, so once again, I can respond to Francis' question, and then Atif, don't hesitate to jump in. But the question of should I transfer to children during my lifetime needs to be carefully considered in light of a taxable disposition taking place, because if property is being transferred to your kids, you may be causing a disposition for income tax purposes, which might trigger and accelerate the capital gains tax that we were discussing earlier under a deemed disposition. In this case, you might be walking into an actual disposition to a child. So accelerating the tax would be a consequence to that decision to transfer properties to a child. And if it's done, commonly that question comes up as a probate plan. But as we've also looked at, there are other probate plans that are available that don't accelerate the tax in the same way as just a direct lifetime transfer. So always go back to your objectives and consider the multitude of tools available, not just what's always the simplest, because the simplest can also, in this case, be the most taxing.
Right. At the end of the day, as Zach said, it's all about the objectives. What is your objective? Will the trust achieve that objective or some other tool? Don't bound yourself by trust. Again, start with your objective and see which tool fits perfectly for your situation.
We only have 1 minute left. Should I just ask the last question?
You can ask the question. We can try to answer.
Okay. Yeah, the last question is we mentioned about the like without doing the estate tax planning, and there's maybe have a double tax issue, but they also have a benefit for the capital loss. We can claim back to the final year's return. So the question is, will all of this happen in the same year?
So, Zach, I can take this one and you can add. So when a person passes away, if I understand the question right, when the person passes away, there's a terminal return that needs to be filed, and the taxation year for that person will end at the time of his death. And then the estate comes into existence, and when the shares are redeemed, it triggers a capital loss in the taxation year of the estate. So the loss can be carried back to the terminal return. It could be the same calendar year, but it's the taxation year of the individual, the last taxation year of the individual, and the first taxation year of the estate. Zach, you want to add something?
I will just add that typically in years past, that capital loss needed to be realized within the first taxation year of the estate in order to be able to be carried back to the terminal return. But recent legislation has been passed that actually extends that time frame now to 3 years. So there's a bit more time in the estate to trigger that capital loss in order to carry it back.
Perfect.
Okay, I think like our time's up. So for all of the rest of the question we haven't answered yet, please contact us like after the webinar to discuss more detail. Thank you.
Thank you, everyone.